Hello and good morning, everyone. Today is Wednesday. This is August 18th, if I am correct. I just did a podcast yesterday, so I'm doing some back to back today. And I am deeply honored to have somebody by the name of Ben Cook here today with me. This is the episode 26 of the PetroNerds podcast. It is August 18th, 2021. WTI is hanging around these $66 levels. And Ethan Bellamy cannot be with us today because he's with his family in North Carolina. But I am honored to have Ben Cook with BP Capital here today, and we're going to talk about a lot of the things that I've sort of wanted to talk with folks about. I know Chuck Yates has a podcast where he worked at Kane Anderson, and he gets into some of this stuff on his podcast. He also had a weekly chat group on Clubhouse where they used to talk about some of this. And I know that Dan Pickering would chime in, and so echoing some of this as well. But Ben actually he's with BP Capital, and they have a couple funds in particular. One is a midstream fund and one is an energy transition fund. So we're going to talk about some of those, and really we're just going to talk about the market. I was really honored to be able to talk to Ben a couple weeks ago, and we discussed the market, and I thought, well, we should just be putting this on a podcast because the content's really great. And you guys know that listeners probably know that I'm a little bit skeptical of how or have uncertainty questions around how some of these operators are valued. Obviously, we're seeing lots of trends in the market right now with share buybacks and everything. So I'm gonna let Ben give a quick 30-second intro about himself and as well as about BP Capital, and then we're gonna dive in.
Thanks very much, Trisha. It's good to be with you. And as a listener of the PetroNerds podcast, it's a thrill to be joining you today. So, as you suggested, I'll give a brief background of my experience in the industry, and then we can dive into the funds and the strategy and our view of the energy marketplace today. I've been with BP Capital for 4 years. The firm was founded under the guidance of Boone Pickens. Toby Lofton started BP Capital Fund Advisors under Boone's guidance back in 2010, and then 2013 we launched two funds, as you mentioned, a midstream fund and energy transition fund. Prior to my time with BP here, I was with a group called Mariner Investment Group. They are a hedge fund which was wholly owned by Oryx. Oryx is a Japanese specialty finance company. I managed midstream assets there. Prior to that, I was with a family office in Dallas called A.G. Hill Partners. It's a branch of the Hill family and descendants of Al Hill Jr. or Al Hill Sr. and Al Hill Jr. and managed public and private equity interests as well as mineral interests. And I managed a drilling venture with a partner in West Texas. Prior to that, I was with a small firm called Opsis Capital, which I was a co-founder along with two other gentlemen that we branched off of our prior positions with hedge funds. I was prior to that was with Carlson Capital, a large multi-strategy hedge fund here in Dallas, working specifically on the energy sector in a long-short strategy capacity. And I got my start in the oil and gas research and investment sector with Raymond James after business school, and that was 1998. So, Trisha, when I started in this business, everybody has a story where oil and gas was back when they started. Oil was $10 in the fall of 1998, and natural gas was $1. So we've
1998 East Asian crisis, and we're gonna come back to that a little bit with the .com bubble. But that was a really fun time with $8 a barrel in 1998.
Yeah, so a little more than 30 seconds on the background, but happy to continue on with the strategy and talk about the way we look at energy. Which direction would you like me to take?
Well, I would like to. So we'll set the preface to this is that oil is at it just shy of we're under $66 a day WTI, and I think that I think that this market is one of the most unique markets we've been in terms of when we're thinking about stocks, right? And BP Capital, you guys largely that's what you're investing in various equities, and I think that a lot of people don't really understand it. If you're analyzing the oil market, that's one thing, but actually the actual stocks and investing in it is a completely different thing. And right now we have massive bifurcation in the U.S. upstream space, where we have privates drilling and going to town as they should be doing, given where prices are at, and we have publics that are supposedly relatively more muted, and they haven't ratcheted things up, but they're still growing, and they're still using maintenance capex, and they're still growing 5% or 10%, or all of them basically in this last Q2 earnings in 2021. All of them, all the big companies which you have in your holdings, basically said they're at the high end of their guidance in terms of production, but not in terms of capex. And so we're all sort of nearing pushing this envelope of production, but I think there's interesting implications for that of, we've not seen I don't think we've seen the regulatory burdens or risk. And I would like to ask you, if you've been in this business a little longer than I have, and you coming into it in 1998, and you have obviously seen the dot-com bubble. And I certainly think we do have froth on the market, not necessarily in terms of energy, certainly green tech and other things. But we have an issue where we have very low interest rates. We do have very real and rising inflation, and we have a movement against oil and gas, a movement against hydrocarbons, which is weighing into how folks invest in it, and a push toward ESG. But that push toward ESG is nuanced, and it's messy, and it could be operators talking about ESG, or it could be folks investing directly in renewables, or particularly, what they talk about as ESG funds. And then we have this whole regulatory burden, which I believe is higher than it's probably ever been. And I say that because I don't think we've had an administration that's, pushed the, Treasury. We have Janet Yellen, who has, folks that are working on climate change within the Treasury. And we also have the SEC looking to actually regulate, actually disclose GHG emissions by companies. And we don't even have a template in which we can all, measure against this. So but yet we're looking to regulate this. So that's a lot of things I've thrown at you, and you can sort of pick what you want. And maybe we can start with, maybe it's your holdings, maybe it's your funds, but overall the market, I think you're aware of, where it's trending and where it's going, and this movement against oil and gas. I'd like to just jump in there and talk about that stuff.
Yeah, sure. No, a lot to unpack there. A lot of topics to cover. I think starting with our view of the energy market and where we see valuations in the context of the commodity is probably a good start. And I think we're not the only ones. The sell side community has written extensively about this, but we've seen, look, a significant disconnect between equity valuations and where we see the commodity price trade. And even if we look out this 12, 24 months on the strip, historically the correlation between the upstream equities have tracked pretty closely to that strip commodity price, and we've seen really a disconnect over the last 6 months, call it, to a point where it's really, you have to ask the question, what is driving that disconnect? What is challenging the market to find interest in these names? And I think you hit on a couple of those aspects, and we'll touch on those. I think obviously we're working through a commodity environment where there is a significant amount of spare capacity that remains on the sideline, and with OPEC's recent decision to scale back on or taper cuts, we will see additional barrels come to market. And we think over time, as that spare capacity is exhausted, we think the market will begin to warm to diminished, let's call it, oversupply risks. So we think that's driving part of the unwillingness of the investment community to come back to the upstream sector. The other thing that I think is certainly significant, and you mentioned it in a couple different ways, is this movement towards ESG. And the upstream sector and the broader energy sector has been, I think, pretty responsive, fairly responsive as it relates to the S and the G, the social and the governance issues. I mean, those are the kind of the low-hanging fruit of whether it's E, S, or G. Those are the low-hanging fruit items that can be easily addressed. And governance, certainly we've seen a move over the last year and a half, with not just in the upstream space, but in the midstream space, a move more towards a shareholder-friendly capital allocation decisions. The industry, obviously enjoying robust commodity prices, is now able to self-fund, pay down debt, and increasingly we're seeing a return of capital to shareholders in the form of dividends and stock buybacks. On the social side, we're seeing these companies, address, the makeup of their corporate structure, their workforce. They're demonstrating a desire to be more inclusive and have that workforce be more reflective of society. I think there's movement there. The harder part, and I think getting to the heart of the matter here, is the environmental aspect of the ESG. And Whether it's Scott Sheffield at Pioneer, over the last year and a half, been a very strong proponent of measurement, evaluation, measurement, and containment of emissions associated with the drilling and production activities in West Texas. And I think he's really the first one to call on the industry to self-govern. And I think the rest of the industry, particularly the upstream, the integrateds as well, are now taking a more proactive approach to get ahead of potential regulation and the potential policy risks that come with government mandates in terms of reducing those emissions. But
Now,
it's
what
it's I was going to say, it's just one last thought. For an industry that is being penalized for a significant amount of greenhouse gas emission, and I think we're seeing that penalty embedded in the risk premium associated with what the cost might or might not be. The market's having a hard time figuring out what that cost is going to be. And we've seen a carbon market evolve in Europe. I think potentially that could happen here. If that happens, we could have a financial mechanism to very easily determine what the value of that emission is. And the market ultimately can differentiate those companies that are doing a good job at reducing emissions, minimizing, eliminating emissions. Those companies will see those risk premiums diminish, and those equities will outperform. And I think that would be good for the entire. That would do very well to bring back investors to the space to see that the industry is resolving the emissions issue and putting a price on the carbon.
So you kind of clarified that as two things, and I want to make sure I have this right. Is that so? Do you think the generalist, because we've been talking about the loss of the generalist investor in oil and gas, in oil and gas equities, for 2 years, for 3 years actually, of them sort of pulling out. And I wouldn't say all of that was necessarily the environmental standpoint. And I think if you listen to previous podcasts, I have a bone to pick with a lot of entities that talk about ESG and really don't actually focus on the S or the G, and are okay touting, BlackRock is okay touting, the E side, but they're clearly have, human rights issues within Xinjiang and China on the S and the G. And as a society, the fact that we're okay with pushing the environment stuff but not dealing with human rights issues is a little mind blowing to me. But that aside, I think that societally people are focused on the E. How that translates into investing is a different story. And I'm just wondering if that's sort of your thesis, is that if these operators, if upstream producers can get a hold of that E. And I would say that yes, while Pioneer's been really vocal, it's not just being vocal. I mean, folks in Denver, we have some of the highest air quality standards in the world in Colorado, and so companies in Colorado have had to adhere to stricter standards on an emissions standpoint than companies, across the country. It wasn't as big of a deal to tout it, and, I think Chris Wright has differentiated himself amongst, oil field peers, and how his ESG report is really about energy poverty. So I think folks on ESG and in the oil and gas community are taking it differently. And I would say across the board, you're right. I think Diamondback, Pioneer, all these guys have made, comments on how they're, what they're doing on the ESG side. I'm wondering that, and I do want to circle back to this, your macro view and the oversupply and how folks think on oil price and how that weighs into investing. But I would like to, is it enough, whatever these operators are doing, because the movement against oil and gas is very, very strong. And I think that I want to know if folks in the equity side and the investor community are interpreting that correctly. It's, just because the operators are changing and doing things, I'm just concerned they're not going to see, the dollars that they're investing in ESG. And I'm not saying they shouldn't invest in it, but are they going to see a return in a share price performance because of that? It seems like there's a lot of things that have to come together for them to actually see that.
Yeah, so there's a couple things. Will you generate a return on ESG, oriented investments? And as it relates to energy investments, I think we look at the renewable category as a collection of companies. It's not an industry per se that is reflective of a longstanding legal and regulatory financial practices. We've got a collection of technologies and companies that are sort of an amalgamation of let's call it green technology. Each of those companies or those verticals, whether it be wind, solar, hydrogen, clean tech, battery power, the rates of return, vary across those subsectors. And so, on a case by case, we could go through each of those and we kind of lay out what our expectations are for returns. But, there's no question that at this point, the return potential of those technologies is very well supported by investment tax credits, production tax credits, subsidies in the case of emerging technologies such as batteries, and so with the return being
And
supported
interest
there,
rates.
it and of course low interest rates, and of course in Europe that's a big issue, particularly in Germany with the treasury curve there being under zero. With a government subsidy of those technologies earning a negative rate of return, it calls into question the validity there. So that's obviously a key point. But many of these sectors are competitive. And you look at the solar cell manufacturing business; it's incredibly competitive. Most of the supply comes from China. The unit costs of production have come down dramatically given scale and technology. And for those that are wanting to make money in the sale of PV cells, it's incredibly difficult to make money. And when you layer on additional challenges associated with the pandemic in terms of rising input costs, a supply chain tightness, and logistical challenges, it makes generating a rate of return even more difficult. And we've seen that in the most recent quarterly numbers for many of the solar component manufacturing companies. So,
And even Siemens has even said that they've warned in the past couple of quarters that their margins are getting really thin on their large wind turbines, right? So I mean, we're seeing that compression.
yeah,
Um,
yeah, we are. And so just to summarize the point, it's not a layup that investors are going to make money in ESG related equities. That we know for sure. Now, if you're taking a longer term view and you are, if you are philosophically married to the idea of being invested in ESG related assets, well, then you can probably stomach some volatility over the short term,
right.
and in the hope of realizing what is significant penetration into a very large total addressable market. And I think that's what the long term investors are really hoping for here. But in the meantime, valuations on many of the stocks across that renewable, so let's call it a collection of companies, valuations remain elevated. And on a quarter to quarter basis, these companies are going to have to demonstrate very strong execution in order to justify the valuations where they are. And so we've been very careful about that. And I know we're dovetailing into the stock selection process, but just to circle back to the ESG issue, again, it's not a layup that investors make easy money in these types of businesses just because they're ESG related. And we think that going back to traditional energy, I think hydrocarbons are going to have a place in the marketplace for a long, long time. You're just not going to snap your fingers and transition to renewables in the form of wind or solar or hydrogen overnight. And particularly to your point, when you think about the number of energy consumers that are growing on a day-to-day basis, bringing those that are in less developed countries into a higher quality of living is going to require a lot of energy. And so, the opportunity to move away from coal into natural gas, that's a big part of the energy transition. And so we look at the energy transition more broadly. It's not just investing in renewables, but we're looking at the trends that are going to unfold over a longer period of
Right.
time.
But
So.
it's difficult, and you summarized that really well. And I think you give me a lot of openings to sort of ask, because there's a lot of different ways I want to take this. And we are going to come back to your some of your portfolios, and we're going to come back to this other piece on your macro view on oil prices and how U.S. equities, Diamondback, EOGs, companies like that can perform. And we'll circle back on Q2 earnings, but this momentum that we have. So explaining the energy transition like that, and I don't, that framework, isn't a bad way to think about it. But when you're investing in equities, stocks and equities, the momentum shift. And I think that so much of that momentum and interest into these stocks, I mean, Kathy Wood is a great example. I mean, she has doubled down so hard on tech. And I very much disagree with her philosophy, and I certainly disagree with her position, her very bullish position on China. I think that the crackdown in China and things happening in China are extremely negative, and it's only going to get worse in China. And I also think that solar and wind are at severe risk because they are made 80% of all photovoltaic is made in China, and the risk that we find out that the majority of that is from a lot of that is from forced labor, not just in Xinjiang but within other parts of the country. That's already probably a reality, but when that comes out and people realize that, it's going to be very hard for folks to buy that tech. So that's sort of aside, but I think that the momentum is sort of this is a you hear it, right? You listen to Bloomberg, you listen to CNBC, you listen to market commentators, and they're saying, look, our investors want more green in their portfolio. They want more ESG. They're doing this. So you have this momentum and this push. And you also have the regulatory side. And I'm curious if this is, and I do think that, the Biden administration's infrastructure plans and his spending have helped prop up a lot of these, a portion of these equities, right? There's a massive amount, there's a lot of money that's going to be going into green tech, and into certain things. I don't think that that's, historically speaking, unless you're thinking like FDR and the New Deal, we haven't had a time in history where it's quite the same. And I'm talking, rock bottom interest rates, a massive push into green tech, into businesses that aren't otherwise profitable, and a big an administration that is, hell bent on climate change, and that is the number one priority as an administration. So that is, to some degree, that's weighing on the market, right? That's a positive catalyst for these stocks. And I'm wondering, this momentum. You've been in this business. We talked about the dot-com bubble briefly, but how does this look like from a historical perspective? To me, some of these are warning signs and flags, and you obviously have to be really smart in how you navigate this, and I'm sure you can be, and nimble in your portfolios and moving stuff around and thinking short term, medium term, long term. But what does this look like to you? All the stuff I'm explaining and that you're well aware of this administration and regulatory side, a risk to the market that maybe people aren't perceiving as accurately as they should. How do you guys think about that? How do you perceive that, and how do you liken it to history?
Yeah, well, let's talk about what we envision, over the next probably 6-12 months from, an administrative activity level sort of. Yeah, so let's talk about what we expect from the administration, and what we've seen, and then we can kind of circle back to, from a comparative standpoint, what do we envision for the marketplace, today versus what we saw back in the dot-com era, the 99, 2000 era. I think, what we've seen thus far from the administration, obviously, is a more punitive approach to managing the U.S. Upstream sector. And then, of course, the irony of Biden doing an about face and asking OPEC to raise production levels last week. That was a real slap in the face. Managed to upset both environmentalists.
All right, folks, we're back. Had a little technical difficulties there. The super fun life of doing podcasting. But we are back, and I'm just going to recap where we sort of were. So I was asking Ben about the momentum and the pressure from the ESG movement and everything that's taking place in the market, and how that's actually translating into how the investment side. So, and I was particularly asking and pushing you on the regulatory burdens and pressure of all the money that's going into the greenflation trade, all the money that's coming in from the administration in terms of stimulus, all the money that's going into green tech, low interest rates, and just the risks sort of to the market right now.
Yeah, no, we'll unpack all that. It's interesting. The Biden administration earlier this year signaled the commitment to green initiatives with a statement after the climate summit when he announced that we'd be moving to accelerate the reduction in greenhouse gases here in the United States, and by about 50% by 2030. And then, of course, just last week we had the announcement that again from the Biden administration that he wants to see the auto industry move towards 50% of auto sales move towards EVs by 2030. So what we're getting is a lot of rhetoric, we're getting statements, but we're not getting very much in the way of concrete, whether it's a policy roadmap or structures that would move our industries more towards or less greenhouse gas emission. That's just not there. And the reality is that there's a big difference between that ambitious rhetoric and the breathtaking changes in law that need to happen in order to bring about these changes. So. But nevertheless, we did get, the Senate passed the infrastructure bill last week. It's going to go to the House over the next couple months. But that of the $1.2 trillion in spending, roughly 10% is going to go to green technology. That's going to go to energy or electric transmission. It's going to go to subsidized battery technology, hydrogen. There will be a significant amount spent on cleanup as well. But again, the power of the purse resides with Congress, and we're ultimately going to need to see the passing of legislation to move us closer to reality in terms of, making a more significant move towards, the proliferation of renewable technologies as a bigger part of our energy source.
That money that's coming in, though, even if it's only 10%, there's a lot of money sloshing around, right? And that still is got the market viewing these green tech very favorably, or at least it had. But I think all that money sloshing around is definitely contributing to inflation, and that is that weighs against not just green tech but tech in general, and weighs it against it. And I think it's kind of case in point of the fact that we're having trouble, even copper and gold, copper and things are needing a lot of investment, but won't necessarily get it, or it has to actually, you have to put shovels in the ground and you have to dig this stuff out for it to work. So it does seem like there's a lot of talk, there's a lot of rhetoric, there's a lot of executive orders, but it's not necessarily translating into direct investment yet. But that's what seems clouded from a market perspective is really, how is that folding out? How is that playing out in the equity world right now? Are folks saying, okay, it's a green light, so we go into it? Or is it, and our valuations reflecting that? Or is it, and is that reflective of why you guys and your funds you're taking a slower approach into how you transition into those assets?
Yeah, well, for us, valuation is first and foremost the key in making an investment decision. And so part of that is assessing the risks associated with not just renewables, but also traditional hydrocarbon investments as well. But, I think what this infrastructure bill does and this continued policy support by the Biden administration does, it de-risks, these various investments for those that would need to feel as though there's policy support coming, continually coming down the road to support the businesses as they evolve and they mature and they eventually graduate to levels of profitability that are comparable with traditional hydrocarbons. I think there's obviously a contrast in the marketplace. There's a divergence in opinion. There's on the one side, you have a cohort of investors that believe that traditional energy is going to go the way of the dinosaur. On the other hand, you have those that believe that there's really no way to substitute the use of hydrocarbons in the manufacture of steel and concrete. You really can't change the patterns of economic behavior that are interwoven with hydrocarbons being a primary source of energy. It's just not impossible to do that overnight. And so, from an investor standpoint, while we do see the policy as a driver and a de-risker, if you will, the investment merit has to stand on its own for these companies. And I mentioned there's, as a collection of companies, there's on a case by case basis, subsector to subsector, there are very differing levels of investment merit that we could characterize. But again, I think you go back to the big picture. The energy transition for us is a gradual move. It's not an overnight move, and we believe that a lower carbon intensity will mean a continued trend away from coal, not just here in the U.S. but abroad. In its place, we think renewables will grow significantly, and we believe that natural gas will be a winner as well. And so, when we place our bets, we look, from time to time, industry conditions, commodity fundamentals, whether it's regulatory or policy by the government, all those factor into what we believe are, or what we think are going to be the underpinnings of investment merit for those various respective groups of investments. And so, when we place our bets today, what do we see? Our view is basically what I just laid out, in that we're going to continue to see hydrocarbon use in a cleaner fashion. We're going to see very cost competitive wind and solar continue to grow with the help of policy support from the government, not just here in the U.S., but abroad, and a continued move towards a technology which will support battery development and broader use of battery as backup. I mean, there was recently a large-scale battery backup power unit that went online in Ventura County, California. Of course, there was a high-profile fire at a Tesla battery pack in Australia. So these battery technologies are going to take time to evolve. We do think the technology is going to get better and the cost will come down. So we have to be mindful of that as an investment opportunity as well. But in a bigger sense, we believe that hydrocarbons are going to remain a significant component in the primary fuel mix. And where we see relative investment opportunity today is in many of these companies, particularly natural gas and some of the integrateds as well, even some of the oil service companies. There will be tailwinds that we enjoy coming out of this recovery from the pandemic that also benefit from secular trends along with the support for renewable technologies. So we see a combination of ways to win.
Right. So, and all that's very valid, and I certainly respect your views on that. I mean, I would like to pick apart a little bit, because I mean, you guys have a fund called BP Energy Transition Fund, and it's on your website, and you have your holdings listed. And this is where I kind of think the market is, and I don't think this is a bad thing, but I think it's a reality check, because 47.7% of your top 10 holdings are largely EOG, Diamondback, PDC, Comstock, Conoco, and the list goes on. And I think for many reasons, I think those are strong names for long term. But the problem is, I want to get back to this generalist investor and the regulatory risk piece that I'm talking about, because I see less, there's potentially regulatory risk in that you have more stuff coming down from the administration down the pipeline on ESG regulation, on GHG emissions that could impact some of these. But in terms of these performers, most of these guys in our Q2 earnings and in the earnings season we just had in the wrap up was, some really big themes that were really present, which was share buybacks. It was these operators talking about how they really thought that they were undervalued, that really looking at strip pricing and even pricing below, current levels, that these guys are profitable. I mean, we've seen big, large scale independents making a lot of free cash flow right now, and yet the market is not showing them that love. And, I've watched them and listened to every earnings call for years. And this song and dance that they're doing recently with the ESG thing doesn't seem to me. I know it matters in a portfolio against your peers and against who you're next to and how you have to compete from an ESG scale. But that, it kind of comes back to that one of those first things you were saying about the macro and prices. Is it, prices moving up? Is it the investors getting comfortable with less volatility in oil prices, that they can come back to this? Because obviously, if you guys are investing in this and, the operators themselves are buying back their stock, they think this is going to go up. And my question is, what are the things that need, I have my own opinions on it and I'm happy to share them. But what does it need, what is it going to take to get those investors back? And what's it going to take to increase that share price and actually give them those returns? And I think it's a number of things, but I'd like to get your opinion on that.
Yeah, no, I think it's a couple things. I mean, I think it's executing on the business model, and it's delivering very competitive returns on invested capital and delivering cash return to shareholders, and we're seeing that. We've seen that over the last several quarters. But that's going to become really the price of doing business, the cost of doing business to attract capital back to the sector. Beyond that, I think it goes back to what we were talking about, addressing the E and the ESG. And if you really want to bring back the generalist investor, there may be a certain segment of that institutional investor that's unwilling to go back to traditional energy based on their view of the future and what they see as the demise of traditional energy and hydrocarbons. But again, we are opposed to that view. That may happen 40, 50 years down the road, but we're going to continue to need hydrocarbons. So we believe that's the case. So in a sense, we're opposed to the way that I think much of the investment community that looks at energy is thinking about hydrocarbons. But it's interesting. There's an analog here, and I think the tobacco stocks in the 90s after the settlement with the U.S. government. I mean, there was an argument against investing in tobacco, and it was based on concerns over demand, much like oil demand concerns exist today. There was an issue of social concerns. Is it philosophically right to invest in something that's viewed as being bad? And of course, there was regulatory risk. And it's interesting. Philip Morris outperformed the S&P 500 by a factor of 20 times between mid 2000 and 2016. And we think as more and more cash is returned to the investor, as investors become comfortable with the industry's ability to recognize, measure, evaluate, right, and eliminate emissions, we think that risk of owning these companies is going to diminish, and we'll see an appreciation in value for many of these companies.
And how much of, and I think, to me, I mean, just personally, there's a difference between, from a stock performance, I think you're right. And certainly I think people have likened, that stock performance before, but I think that really Philip Morris's demand is that demand was relatively, it was maintained. I think it's different because, from a global standpoint, I mean, oil and gas companies are providing a valuable, a needed commodity versus a desired commodity or a desired thing, such as cigarettes. Though this bringing this generalist investor back, bringing folks back and them seeing those valuations. And I think it's also something that once somebody starts making some money and it starts working and one shoe has to drop and people have to sort of follow suit and say, I need more exposure to different things in my portfolio. I can't be, I've said it on the podcast before and I say it to clients, you can't be all tech all the time. I don't think Cathie Wood's portfolio is resilient. And I think it's, you have to have, having oil and gas in your portfolio, sort of, especially in an inflationary environment, is something folks need. And we started hearing that, I'd say, a few months ago. You started seeing, folks at least talk about saying, okay, they're actually talking to their clients about putting a little bit more oil back into their portfolios. And I think while they're not touting, we're not seeing that necessarily from a media standpoint on CNBC or Bloomberg. I think that's probably happening to some degree. But I also think oil prices being, increasing. It's kind of the story for the U.S. is the question of, well, how come these operators haven't increased their increasing output? And I would say, their oil prices have jarred them. Last year was such a jarring, impact to the industry of negative oil prices and just the devastation that the market hit and all the things that they had to deal with it, not just being prices, but not actually being able to move their crude. And so I think that, oil prices and your view on sort of the macro and saying, is it the volatility that needs to go away? So is it a stability in oil prices? I would say that to me would be something that from an investment standpoint, if I'm an outsider and I'm looking into oil and gas, it would be that, yeah, prices are 65 and they're hanging there and that's steady. And it makes these companies, their profitability much more stable than this massive swing. Otherwise, they're probably we're going to have all these hedging. So I'd imagine now it's just how long does it stay there and how does that bring the investor back and how well do they perform on a free cash flow standpoint?
Yeah, no doubt. I mean, reduced volatility is always a good thing for financial valuation. And when you look at equity values in many of these energy companies, as we started our discussion, there has been a very stark, disconnect between what historically has been a good correlation between the longer term strip of the commodity and the underlying performance of the equities. And I think and we talked about the, diminishing capacity, spare capacity at OPEC as they continue to bring volumes back online. But yeah, stability in the commodity is a big part of it. But I think it's cash return. And I think that's, going back to the Philip Morris example, there's a significant amount of cash return, a very attractive dividend yield that stock pays. And I would imagine as the industry stabilizes through the recovery in the pandemic and producers continue to demonstrate capital discipline and focus on shareholder return, that over time yields will look very, very attractive. And we're not going to live in a world forever where money is effectively free and interest rates are suppressed and artificially low. I hope we don't, because I don't think the world will work very well, and the economic and financial world won't work very well in that environment. And there will be a time when this investment, a cash return or an attractive yield, becomes more attractive to investors. And I think that day is probably coming sooner rather than later. And we were talking about interest rates. Look, you as we normalize from this pandemic, going into the pandemic, the 10-year Treasury was at 2%. I mean, at some point we have to come to terms with the fact that rising interest rates are actually a good thing for our financial markets, and they indicate an improvement in economic health in our economy. And if we look back to 99 and 2000, the Fed raised interest rates 3 times in 99. They raised rates 2 times in 2000. We could be setting up for a somewhat similar environment given the risk appetite that we see in the marketplace today, where traditional assets, traditional hydrocarbon companies that generate very good levels of cash flow and return that cash to investors, that they become the outperformers relative to the technology names. And so it's very likely that in that environment, you have an increased sort of focus on energy, traditional energy, which, in today's world, at today's commodity price, are generating very, very good returns. So,
and I think that you paint, that's a bullish, I mean, that's the scenario or outlook in which, energy could technically outperform. I think that's fascinating. I also think that probably dovetails and comes back into how they actually perform, because I always explain to folks the way I view operators. It does come back to how well you're drilling these wells. And the trends and themes that we heard over the last quarter were certainly longer laterals, faster drilling times, faster completion times, the ability to hedge against inflation with offsetting these costs. I think it was Exxon had talked about their ability to, they didn't need as many rigs, and they didn't say that directly, but essentially that they just said, hey, if you look at our lateral length and the speed at which we're drilling, and you compare that to our rig count, in 2018, we don't need as many rigs. And they say that in particular because they went from 55 rigs and now they have 8 rigs. But overwhelmingly, most operators are doing all that. And I think that when you're looking at this as a whole, this reminds me a lot. And it's not the same. I mean, the profitability of these companies is real. You're seeing real free cash flow generation, but it does remind me a lot of 2014. And when these companies were, companies got smarter and they took time in the downturn, and not as smart as they could have, but they took that time. They got smarter. They landed the well bore better. They landed the well in slightly better rock, and incremental moves like that, in addition to these incremental moves on lateral lengths and efficiencies and everything, they'll add up to a little bit more production, and they all add up to be a little more resilient. And I would say that they, they're relatively muted in, they're not drill baby drill. Certainly the private companies are, but I also think, are they leaving money on the table? Because we don't have a promise of oil price stability. And I do think that, IEA, and I talked about this in my last podcast, but the International Energy Agency, came out with their monthly report, and they were kind of warning of saying, okay, well, we'll basically be perfectly in line for supply and demand, or relatively tight there for the third and fourth quarter of this year. But they talk about the risk of being oversupplied next year. And the reason they're saying that is because, demand gets a little muted, I think, for the virus this year. And then next year, with all these, the OPEC supply additions that are coming back, we already have Saudi Arabia well over 9 million barrels per day of production. OPEC production is increasing. And that is part, I think, some of the softness we're seeing in oil prices right now, just this added supply. Not that it's not being absorbed, but that it's there, and it wasn't there a couple months ago. But you sort of have there's a change a little bit in rhetoric and tone from this super cycle and this bullish cycle and oil prices going to 120. I haven't heard Goldman Sachs or anyone get on TV lately and say oil prices are going to 120 because of these things. And I think that supply, folks, certainly OPEC and Saudi Arabia, Saudi Aramco has come out and said, we're putting that money into CapEx and we're going to produce. BP and Shell, of course, are not saying that, and they're trying to pivot out of oil and gas. But I mean, U.S. producers, I have to say, look at them and say, you're making this money. You make money by drilling and producing oil. I personally think they should be producing a little more, whether it's 5 or 10%, or eking out a little bit more production, because if prices are to slip, they've lost that opportunity to capture those gains. And, and they need to, because that's the game of the oil market, is that the folks outside of the U.S. are going to do it. And I'm not certain these guys shouldn't be trying to increase output a little bit more, over the next year.
No, I mean, it's a valid argument, although, historically the industry's decision to ramp spending in a pro-cyclical manner has always ended up in disaster. And when downturns ultimately emerge, it's hindsight is 2020, and the capital destruction has been awful. And I think that's, we're at a point where we're evolving as an industry, and we recognize that it's incredibly difficult to predict where commodity prices are going to go. And for investors to retain an interest in the sector, they have to be rewarded. And I think that's one of the governance issues. The alignment of shareholder and executive and management incentives has probably been no greater than any time in my career. And that's a very favorable change. And that means, managing your production growth only to a level to sustain existing volumes and grow minimally, at which level provides, some degree of growth for the benefit of either debt reduction or, equity appreciation. And I think, we are at a point now where the industry is there. So, the privates are a different story. They answer to a different constituency, and they're going to continue to build, to grow. But although we are seeing, some zero premium deals, we're seeing privates sell to publics. And I would imagine there's probably very little, gain to be had in some of those private deals that we've recently seen. But nevertheless, it is a game of scale now. I mean, but that was the major change with the shale boom, is that, the industry really moved towards a manufacturing phase, right? We're trying to wring out cost efficiencies and productivity gains. As long as we can do that, if you're in a scale business, it doesn't matter whether you're producing widgets or producing oil. If you can reduce your costs and take advantage of those scale benefits, well, then, that's going to generate a benefit to the investor and to the equity owner. So
those investors, though, and I only want to interrupt here because you're on this point, and I would like to take you to take it a little bit further, or question. I've always had a bone to pick with when I meet with investors or analysts and stuff, and I think about, they're like, now you hear Pioneer and you hear all these operators and they say, folks ask them on the earnings call, are you going to hedge? And they'll say, and you have heard more questions about hedging now. And I think it's because folks want to know, are you going to be able to maintain that, your maintenance capital and grow by 5 to 10% or whatever it is. And I think this question hedging is interesting because you never need to hedge when prices are good. And then hedging is all very important if prices are to slip. And so there is a risk, that folks, and OPEC is seeing it, that there's a risk that folks sort of hedge in the second half of next year or the beginning part of next year. And personally, I think as they should, to maintain stuff. But the investors, I think it was Scott Sheffield who said in the earnings call, we'll wait to hear from we're going to start doing the road shows again, or we're going to listen to our investors and what they want, if they want these variable dividends and share buybacks and everything. And I think it was directly with regards to hedging. And I thought, the problem I have is investors change what they want over time. And, they push these, and I'm not saying you or BP Capital in particular, but I'm saying investors pushed shale companies to buy into the Permian at any and all costs, no matter what it costs. In the heart of the downturn when prices were sub 50, they pushed them to go buy that. And then immediately the investors turned around and said, oh, and by the way, you need to be free cash flow positive. And that was ridiculous. And I think so the whims of investors, which are now super into ESG, change. And operators have to deal with that. And I'm not saying every operator has done a super great job of running their business and not burning cash, which many have. But at the same time, they were pushed to do it. They were pushed to go buy into the Permian, and that's what the investors want. And now that they buy into the Permian and then they say, oh my gosh, well, you spent too much money on that. And I kind of wonder, I know things seem calmer now, and partly that's because of price, but are there any risks into that? And do you think there's a better dialogue between, you're kind of describing it, but is there a better dialogue between the operator and the investors? And, I don't think every 30-year-old New York analyst, 35-year-old New York analyst knows exactly what they're talking about because they're not in the field. But I'm just wondering, is there a better understanding between the two of this is what we need to do to move forward? And this is oil. These are oil companies. They need to be producing oil.
Yeah, I think in today's environment, I think there's a agreement between Wall Street and, let's call it the oil patch. I think there's a recognition, a mutual understanding between both that, again, that the industry has historically done a fairly bad job of generating, acceptable returns on capital employed. And, as an alternative to, you go to the point of hedging, we're what we've seen over the last couple of quarters, these companies have accelerated the debt repayment to a point where many of them are going to achieve their debt level targets, whether it's 1 or 1.5 times leverage. And at that point, the balance sheet becomes a natural hedge, right? Like, you're not going to have to necessarily go and hedge, significant amount of production to offset your base decline rates. You're not going to have to hedge.
You have more liquidity. Yep.
You have the ability to self-fund, and so you have the ability to take more risk with your balance sheet. And I think, that is a great place to be from an equity holder's perspective, to benefit not only from, a base business that has visibility in terms of production sustainability, but also the opportunity to capture the optionality associated with the upside of the commodity. And historically, those two necessarily haven't been a part of the investment proposition for investors.
Yep.
If you had the opportunity to benefit or participate in commodity upside, that usually came with high levels of debt, that came with overspend.
Yep.
We're not seeing that today. We're seeing these companies, self-fund and pay down debt and now buy back shares. And if they can get to a point where the balance sheet's resilient, well, they have the ability to participate in significant upside in the commodity. And so, that's kind of the best of both worlds for investors. So I think that's very attractive. In the environment today.
I think that's extremely well described. And I agree with that because I was thinking back to, if folks, when a lot of folks didn't understand hedging a couple of years ago, and I would always explain, folks like Exxon, big companies don't really have to hedge because they have the liquidity, have the balance sheet, and they traditionally can handle that risk, and they can ebb and flow with that. And as these companies become far more profitable, as they have the balance sheet flexibility, they won't need to. And if that can be translated, and the generalist investor, I think, can understand that the risk, it's less, yes, higher oil prices and less volatile prices are great, but really, the listening to these operators, paying down debt, paying down debt and having just greater flexibility. I mean, I think the concept of, share buybacks and variable dividends, those are all sort of great things, but I even a few years ago, companies like Extraction were doing share buybacks, and companies were borrowing money, taking debt to do share buybacks when it didn't seem to make any sense at all. And now, obviously folks are not borrowing and taking on debt to do share buybacks. So it seems that they're literally doing share buybacks because they think that's the best, at least one strategy to do with some of the capital and some of that cash on hand, because they think that the stock will be going up. So I think that it sort of makes sense. That needs to be translated, I think, into the overall market. And there needs to be sort of probably a more favorable view on oil and gas and just the profitability of these companies.
No, I couldn't agree more. And therein lies the investment opportunity. Again, whether it's a lack of recognition of the visibility that associated with, resilient balance sheets and commodity optionality, or whether it's, the risk associated with ESG. I mean, these companies, I think over time, the risks will fade and the risk premiums will fade and the stocks will begin to outperform. We're kind of in a show me state. I mean, the industry needs to put up, sequential quarters of discipline and cash repayment. I think that, if we can hang here in the $55 to $65 level, longer term, and it's clearly a price that's below which I think the Saudis would like to see. I mean, if OPEC can sustain their end of the deal too in terms of restraining supply, well, then I think we're going to be in pretty good shape. But we have a favorable outlook on oil and for natural gas, and underpins our enthusiasm for much of the upstream sector.
Does your view on oil? I mean, so if oil prices were, and I need to probably full disclosure. I mentioned this in other podcasts. I think I bought a tiny bit of Exxon, a tiny bit of EOG several years ago. I have not made money on it, but I just those are my long only, so I do not trade them. But do you guys have a view? I mean, if oil prices are to go to 55, obviously prices will, shares will slip and things like that. But to me, it would almost be in theory, it would be a buying opportunity if I see the response of those companies and how they react to it. If they turn tail and run, and they drop all the activity, because you were commenting on, it hasn't worked out for operators to invest, to drill when increase production when prices are going up. And I agree with that, except I also don't like when they drop when prices go down. Because truthfully, I believe this with all my heart and soul, you should have been drilling in 2020. You should have been drilling and completing in 2020. Maybe not bringing those wells on, but you had rock bottom drilling prices, rock bottom everything prices. And companies that did not drill and complete wells missed out. And the companies that we did see were private companies like TapRock and companies that just went to town. And now they're all going to town and they're spending, aggressively in upcycle. They should have been spending really aggressively because we knew prices weren't going to be at minus 37 forever. We knew they weren't going to be at 40 forever. I mean, anyone with the back of the envelope, horrible macro, skills could figure that we couldn't stay at $40 oil. So, but they didn't. And they missed in my mind, a lot of operators missed the opportunity to really, be at a point where they could ramp up production now. And part of that may be because public companies didn't want to show that they were ramping up. But I mean, EOG at least commented that they bought all their tubulars last year for 2021. And so they, were smart enough to see the market. And I just think that there's opportunities then where, you can really, and you got to explain that to the market too. You got to explain that to your investors. And I mean, whenever EOG would pivot, to a thinner part of the Eagle Ford, they would at least try to bring their folks along saying, hey, these wells are going to get a little worse. But just we're moving to a thinner part of the reservoir, but they're going to get a little worse. But just, here's our guidance. And I'm just not sure every company doesn't do the best job in translating that. And the more they focus on ESG and the more they focus on, share buybacks and all this stuff, I still think that they really need to translate what they're doing on the ground and make sure investors understand that this is, they've gotten to a point where things are cheaper, faster, it is more of a manufacturing, and that they can hold the line on that and they still have the flexibility in their balance sheets. But what happens if prices drop to 55 tomorrow? Are people going to freak out, or do you think it's an opportunity to sort of layer in more?
No, look, we could hypothesize on all kinds of pricing environments. I do think the drilling budgets are generally set, at the beginning of the year, if not the end of the prior year. And so those budgets are based on outlooks for the commodity that are generally conservative in nature. And so operating budgets and operating plans are generally not going to change all that much with with volatility in the commodity. Now, extreme volatility obviously would create some pause, and we saw that with the downturn last year with the onset of the pandemic. But it's hard, obviously it's hard to get an organization to ramp spending into what is, was a once in a 100-year event. And
Right.
it was tough for risk managers to, even financial risk managers to determine what the potential outcome was for the commodity at the depths of oil being negative last year. So, that's tough to handicap. But I think at this point, I think there's a recognition that the oil market is under repair. The gears of recovery are turning in the right direction. We are seeing spare capacity diminish with OPEC volumes coming back. The degree of underspend in the industry has been severe. We're going to be about 50% below spending levels that we saw in 2019 from an upstream CapEx standpoint. So, that's going to have an impact on the industry with respect to, offsetting declines, not just here in the U.S., but abroad. And, that does set up a longer term upside case that's very favorable. Now, I think what we're seeing today in a move from, WTI being, down $10 or so from, what was it, June, July sort of levels. We've seen a pullback a little bit in the commodities, and there's no question that, macro traders are driving some of the performance in the equity that generally track the commodity. But I think if we were to move back to 55, we would continue to see some weakness in the equities. But again, I feel like the demand outlook is very strong, and the recovery from the pandemic is going to continue to unfold, whether it's getting through the Delta variant or continued vaccination. We'll continue to see mobility trends improve, particularly with jet fuel demand. That's going to happen over time, and eventually we will get out of this. I wouldn't bet against the human race when it comes to, deploying ingenuity and technology to solve a problem. We've seen time and time again that they're capable of doing that. And so I'm favorable in the outlook for demand and for economies, and ultimately the consumption of hydrocarbons that will come with that. And obviously the energy industry has not been in a growth mode in a long period of time, and I think all the fiscal stimulus, the economic stimulus that's coming from economies around the world, governments around the world, that's going to play a part in it as well. And I think, when you consider that the contribution to demand that comes from that stimulus, we see that as a favorable tailwind as well. We think that, a combination of those demand drivers should set up well for commodity price buoyancy over the next several years.
Right. Well, Ethan always pushes me to do this near-term price forecasting, and I did it on my own yesterday when I was doing it. So I don't like near-term price forecasting, and I had a pretty wide band that I was in. I was 65 to 75, so I was right. I think I always say it's pretty easy to be right in a band like that. I like that you have this bullet. I'm with you on demand. I think demand is steadily going to grow. We've certainly shown it in the U.S. That we've surprised the upside on demand. We obviously have massive throughput at TSA at airports that has doubled. Where it's been waning a little bit. I think we'll see a bit of a jagged recovery as unemployment benefits roll off. Folks have to get back to work, and the nervousness about this about the virus. But overwhelmingly, people have sort of really shot to the upside over the summer, and we've seen that demand. I have more of a cautious approach on a super cycle in oil prices, simply because production follows suit. Production follows price. And the U.S., some U.S. operators may be less inclined to increase output tomorrow, but the dramatic increase we've already seen in OPEC at nearly 27 million barrels per day. It's ratcheting up, and we're going to see it. And the market's going to have to just disseminate, understand, and absorb that. And I don't think the market can handle this production. But I don't have the doomsday outlook that folks can't increase output. I do think that the Saudis can increase output. I do think Russia can increase output. And I think United Arab Emirates wants to. Lots of countries want to increase output, especially at these price levels. I'm going to, for technical reasons and making sure this podcast uploads, I'm going to ask that we probably close. The last thing we probably didn't get into, and the only sort of modest disagreement I'd have is on, the risk, the short-term risk of politics and dynamics of the, I think you guys the way you've sort of weighted your portfolio and how you've explained how you invest, actually makes a lot of sense. And it sounds like you can be nimble. But I think that, as you mentioned, with Congress not putting a lot of this into law yet, and this is the executive order, and it has to translate into reality, that there is risk both from a Fed standpoint. And I mean, we have a very inflationary environment in the U.S. We have a dovish Fed on that inflation, and we have we have a administration who I think is a little bit undetermined right now on how they see inflation. I mean, the press secretary just last week was talking about how if inflation is not as bad as people think, and it's recovering and it's transitory. And I think there's a reality that when things cost more, and it eats in. Already, people are feeling the bite of higher gasoline prices in the U.S., especially to the middle and lower income, and they're feeling the bite of higher prices. And I think if inflation goes unchecked, not just in the U.S. but around the world, it does in turn impact oil economic growth and oil demand. So it's just a concern. It's something I think about, and I think from a regulatory risk standpoint, I think that this administration creates as many opportunities as it might create in the green sector for investing. The fact that it's political and it's a 4-year cycle, those can go away tomorrow, just like they did from Trump to Biden. So I think that's just a risk but I think that you probably look at the equity market and you assess that and approach it and move around your portfolio accordingly.
Yeah, we certainly do. And we adjust based on what we believe are going to be changes in policy and regulatory impediments to grow in the industry or the opposite, to crimp the industry. So, it's flexibility to your point, being nimble and the ability to pivot across value chains, both traditional and renewable, I think is going to be, a beneficial quality. But we think we're unique in the marketplace, and we think it gives us that element of whether it's flexibility or being thoughtful about what, the best way to make money. We think we're equipped to do that with our strategy, the way it's set up. So
awesome.
Yeah.
Well, I in the favor of time, I think, as Ethan would say, a natural close, and I'm forcing sort of a natural close, so I apologize for that. But I really appreciate you taking the time. I very much enjoyed the conversation. I'm glad that you were okay with my pushing you and sort of the banter and disagreeing a little bit. But loved your insights, and I really appreciate you jumping on the podcast with us.
Well, it's been a pleasure. Thanks so much for having me, and look forward to staying current with you going forward.
Absolutely. And we'll definitely have you guys back again soon and to recap on this stuff. So thank you very much. Again, this is episode 26 of the PetroNerds podcast. I'm your host, Trisha Curtis, CEO of PetroNerds, and my guest has been Ben Koch with BP Capital, full of lots of insights. So we'll be with you next week. Thanks, guys. Bye.